In a Fox Business exclusive, D.A. Davidson Director of Research, Gil Luria. Gil, thanks for coming on. Good to see you.
Good to see you.
Do you expect to see much more consolidation, and do you think that's a good thing?
Oh, absolutely. There's a lot of marginal players, unregulated small players that aren't necessarily even good actors that are going to go completely away. Then there's just weaker companies that are going to get bought by the stronger companies. It's like the business cycle we see in other parts of technology. It's just much more pronounced. It'll play out faster, and the bigger companies, the well-managed, real companies with real capital, will be able to consolidate and come out stronger on the other side of this.
Name a few of the strong ones if we're doing survival of the fittest here in the crypto world.
Well, Charles had Michael Sonnenschein from Grayscale, which is part of DCG. That's a real company. Obviously, Coinbase is a real company. Kraken, Gemini, Galaxy Digital. These are real companies that operate in this space with very good leadership that will emerge on the other side of this. They're diversified. They're managed conservatively. They've been around other types of companies. So I expect them to do well and benefit from other companies as they dissolve.
A lot of people are paralleling what we're seeing now to the run on the banks that happened in the early 1900s. At the time, you didn't have a central bank. You didn't have a Federal Reserve to come in and regulate, to bail out, to help. When we're done with this crypto winter, whenever that is, do you expect regulation to come into existence and be appropriate enough to actually keep these markets functioning more safely with less volatility?
I think it's a great analogy. I think that's exactly where we are. Most of it's like the Wild West in crypto. The regulation exists. It's just harder to enforce because crypto looks slightly differently. The crypto-related assets and securities look slightly different than the ones that exist in other asset classes. And so regulation is unclear, which has meant that there's a lot of bad actors there doing things that we wouldn't allow in stocks, bonds, or real estate. And that's where we were 100 years ago in those asset classes. And a lot of the regulation that I have to live with as a stock analyst at an investment bank was created 100 years ago in response to the Wild West that existed in stocks. I expect that to happen in crypto. Current regulation will be applied to crypto assets and companies, and new regulation is going to come in to clarify where the lines are. So all the good companies, the ones we mentioned earlier, will know how to operate safely and be able to protect their consumers. So it's very much needed. And again, Michael Sonnenschein said that in the previous hour, which is he'd love to see regulation. It makes a lot of sense.
Just one quick question. We're running out of time here, Gil, but what is the value of cryptocurrencies in one's overall portfolio if we're seeing increasingly, particularly with Bitcoin, the largest cryptocurrency, that it's trading in lockstep with the NASDAQ? What's the use case for it in a portfolio if you're seeing it trade along with the NASDAQ most of the time?
I think it's a short-term phenomena that crypto assets are trading with the rest of the market. I think longer term, they're uncorrelated because their fundamental drivers are uncorrelated. But as always, we always recommend that crypto investments are higher risk and higher reward. So investors should only put what they're willing to lose in such a high-risk asset class.
Well said. Gil Luria, thank you very much.